Wealthy investors utilize debt as a calibrated financial tool. To build a fortune, they prioritize purchasing power over the traditional goal of absolute debt-free living. To see how this engine works, let's look at a base block of capital. Say you've saved up $100,000. You could take that cash and buy an asset outright, or you could use it as a 20% down payment to control a property worth $500,000. You now have exposure to an asset 5 times larger than your actual cash on hand. If the real estate market grows by 10%, that $500,000 property increases in value by $50,000. But since you only invested $100,000 of your own money, that $50,000 profit is a 50% return on your investment. Compare that to the all-cash approach. If you bought a $100,000 asset in cash and it grew by 10%, you made $10,000. By utilizing the bank's money, the exact same market movement generated 5 times as much profit. This is the core mechanic of real estate leverage. You are using the bank's capital to artificially multiply baseline market growth into outsized personal wealth. To see how this math plays out over a long time horizon, let's track a real-world residential building purchased in 2004 for $500,000. The buyer put down $100,000 and financed the remaining $400,000 with a mortgage. In the first year, the tenants paid enough rent to cover expenses and put $7,000 of positive cash flow into the owner's pocket. Simultaneously, that rent paid down the loan principal by $6,000. Add in $26,000 of market appreciation, and the property returned $39,000 in a single year, a 39% return on the original equity. Fast forward 17 years to 2021. The market has grown, and this same building is now valued at $1.5 million. Over those 17 years, the tenants have also been chipping away at the mortgage month by month, bringing the loan balance down to just $300,000. This brings us to a critical financial concept: equity. Equity is simply the total value of the property minus what you owe the bank. $1.5 million in value minus the $300,000 debt leaves $1.2 million in equity sitting inside the asset. The combination of time and leverage grew a standard down payment into a 7-figure net worth without the investor injecting any additional capital. But leverage is a symmetrical force. The same multiplier that builds fortunes will amplify your losses. If the market takes a hit and that $500,000 property drops in value by 10%, you lose $50,000 in equity. A tenth of the property's value vanished, but half of your down payment was wiped out. Because of this risk, investors monitor their loan-to-value ratio. Borrowing less than 75% of the property's value leaves a conservative cushion. Pushing into the 85% range and beyond is aggressive. The more you borrow, the thinner your margin for error becomes during market corrections. A building is not a frictionless asset. You are constantly managing holding costs like mortgage interest, property taxes, insurance premiums, and ongoing maintenance, which all erode your profit margins. This chart tracks historical U.S. mortgage rates, which dictate the viability of the leverage strategy. Right now, rates are between 6.5 and 6.6%. While that is higher than the record lows of 2.65% back in 2021, it is still moderate compared to the 16.6% spike investors faced in 1981. Leverage is a volatile engine. Running it successfully requires management of borrowing costs and equity cushions to prevent a total portfolio collapse. When you manage that volatility, you can start scaling. If you buy a property outright in cash, a typical net income might yield an 8.4% return for the year. But if you finance that same property and only put 20% down, your cash-on-cash return jumps to 16.2% because your initial investment is so much smaller. So if you have $100,000 in capital, you have a choice. You could buy one house in cash, or you could split that capital into 5 separate $20,000 down payments and purchase 5 separate properties. Owning 5 properties multiplies your income. If one house yields $270 in monthly cash flow, the portfolio brings in $1,350. This scaling also applies to market appreciation, turning a standard $30,000 market uptick into a $150,000 gain in equity. Spreading your capital out also insulates you. If a tenant moves out of the all-cash house, your income drops to zero. But if one tenant vacates in the leveraged portfolio, the other 4 properties continue to generate income to offset the temporary loss. Strategic debt allocation allows investors to capture systemic market growth while mathematically insulating themselves against localized tenant defaults. But as an asset grows more valuable, its capital efficiency drops. We measure this using a metric called return on equity, which balances the total annualized return your property gives you against the total wealth you have trapped inside the asset. Let's look back at our 2021 Fourplex. Rents had increased, bringing cash flow to $52,000. Add in $13,000 in principal paydown and $96,000 in appreciation, and the property generated $161,000 in a single year. Making $161,000 sounds incredible until you check the bottom half of the equation. Dividing that return by the $1.2 million in trapped equity reveals that the property's efficiency has dropped. The return on equity has fallen from its peak of 39% down to just 13.4%. A soaring net worth can mask a severely underperforming asset base. Your money has mathematically gotten lazy, turning a financial victory into a hidden liability. The theoretical solution is to extract that $1.2 million in equity and use it as a 30% down payment to purchase a massive $4 million apartment complex. By acquiring the larger asset, your annualized return grows to $330,000. You force your money to work hard again, resetting your return on equity back up to 27%. But here is the structural reality. To get that money out, you typically have to sell. And the moment you sell, you trigger broker commissions, closing costs, and a capital gains tax bill on nearly 2 decades of appreciation. The wealthiest investors must constantly extract their equity to avoid stagnation. Yet the tax code is designed to penalize this exact mechanism, creating a high-stakes structural trap that requires a specialized exit strategy. We ended our last chapter with a mechanical problem. As a property appreciates and tenants pay down the mortgage, your wealth gets locked inside the walls of the building. Accessing that value through a sale triggers a capital gains tax bill. Many people view a bank as a secure storage vault, a place to park money for safekeeping. Investors see this institution as an extraction facility. It is a tool used to transform trapped equity into liquid cash. The maneuver that powers this extraction is the cash-out refinance. The mechanics work like this. You replace your existing mortgage with a larger loan. The bank pays off the old debt and hands you the difference in cash. You still own the property. Your tenants are still generating monthly income, but you have successfully pulled the wealth out of the brick and mortar, making it liquid. This diagram shows the numbers from our 123 Fourplex Street case study. The property is valued at $1.5 million, sitting next to a remaining mortgage debt of $300,000. That leaves $1.2 million in raw equity. Banks require a safety margin to protect their capital. A traditional lender will usually let you borrow up to 75 to 80% of a property's total value, a metric known as the loan-to-value limit. Running the limit on our valuation, 75% of the $1.5 million Fourplex equals a new $1,125,000 loan. The bank issues the loan, satisfying the old $300,000 debt. The ledger clears, leaving $825,000 in liquid capital. This leads to the central question of the strategy. What is the federal and state income tax owed on that extracted capital? 0. Tax authorities classify borrowed money as a liability, a debt that must be paid back. As a debt, it is not classified as taxable income. The strategy centers on borrowing against the asset rather than selling it. We saw this when investors leveraged stock portfolios for tax-free cash. The mechanics are the exact same. They are simply being applied to real estate. A cash-out refinance has limits. Eventually, the return on equity drops, the capital becomes mathematically lazy, and pulling out cash is no longer sufficient. To grow, you must trade up to a larger building. To sell an asset and scale up without triggering a tax event, investors utilize Section 1031 of the tax code. This equation illustrates the first requirement to defer taxes. The replacement property must be of equal or greater value than the one sold. If you sell for $1.5 million, you cannot buy a $1 million building without paying taxes on the difference. Second, as this loan comparison shows, you must carry over the leverage. Since our old property held $300,000 in debt, we must take on at least $300,000 in debt on the new property. Failing to meet these debt or value requirements triggers a tax penalty known as boot. Look at this calculation. Imagine you swap the property, but the new loan is only $200,000. That leaves a $100,000 gap from the previous debt load. The IRS classifies that debt reduction as a gain, and it is immediately taxed. By adhering to these rules, equal or greater value and equal or greater debt, An investor can cycle equity into larger assets while deferring the tax bill. Major economies outside the United States provide similar incentives for real estate debt. In India, Section 24B offers rewards for utilizing leverage that mirror the benefits found in the U.S. Code. In both systems, the tax structure is designed to favor the use of debt to control property. This flow cycle summarizes the operation. You use a small down payment to control a large asset. You let the tenants pay down the debt while the market provides appreciation, and you monitor the return on equity. When that capital is no longer efficient, you execute. You extract wealth tax-free through a refinance, or you use an exchange to roll the equity into a larger property and scale. This logic, using debt to multiply growth while avoiding taxes, is not restricted to bricks and mortar. What happens when the same debt multiplier mathematics are applied to acquiring and scaling corporate companies?